So I want to talk about, I guess, when we're purchasing investment properties, making sure we're doing the right due diligence and the property is actually putting money in our pocket after all expenses. Majority of people go out there, buy a property, it's negative gear to try and write off tax, and actually you're actually costing yourself more. When you look at all the money you've been putting towards the property, your own personal savings, that money is going down the drain. A true investor wants to make money. So I wanted to do this video to give you an understanding about what you can do to strategize and plan ahead. If you've got equity, to use your equity, so you're extracting equity from your property. If you've got investment properties or your family home, you're taking that equity out as a loan and you're going to use that as a deposit to buy more property. Now, there's ways you can go about that. Doing that, of course, go to your broker or bank. But why you do that instead of using your own cash to purchase property, if you've got the cash, is because that equity you're taking out of the property, if it's your family home or investment property, it's tax deductible, especially if you're using that equity to go out and buy investment properties. Now, you can claim that deposit that you're putting let's say, you're putting a 10% deposit on that investment property. Now, if you put your own personal savings as a deposit, now that let's say you buy a property like you can see here on the screen of $300,000, that's a $30,000 deposit you've got to come up with as a 10%. If you use your own personal savings to put as a deposit, that's not tax deductible. So you can't go tax on and say, I bought a property, I put a 10% deposit, I want to claim that $10,000 at tax time. You cannot do that. It's illegal. But if you take out equity from that investment from your family home or investment property, and you use that $30,000 as a deposit to put down as a deposit, not as a home loan, just as a deposit, that $30,000 that you put as a deposit now, you can actually claim as a taxable write-off. So you can write that off tax. Now, I want to show you by putting a 10% deposit down. If we purchase this property, and let's say it's a free $350 per week, you got your stamp duty and you got your LMI fees that you pay. Now, what I want to show you is if we have a property, and let's hypothetically say you'll purchase the property, it's on a principal and interest, so you're paying the debt down. And what I want to show you is, let's say you've got an offset account. Now, I've turned it off. Now, how offset account works is, look at this property, you've paid $300,000 for it, and you put a 10% deposit down. You've got an interest rate of 3%. As we scroll down, you've got a loan of $270 per 270. So you got a loan of what you've got from the bank. Now you have to pay that debt back. So how do you do that? You have to pay the debt back from your rental income. Now, if we scroll down, if we look at the property here, we got that's your interest that you're paying on that 275 from the bank. So that interest is at what you have to pay back every single year at 3%. You've got as well when you start to reduce your level of debt here, you actually pay less interest. Now, you got your rate, your council's rates, you got your property management fees, your levy fees, and insurance. Now, let's just have a look at this property. Now, on a principal and interest, it's costing you $600 to hold the property, which is a 6% yield, and this is what we average, a 6% yield for our clients. Now, what I want to show you is, let's hypothetically say this is where people would rather use equity instead of your own savings. What you would do, let's hypothetically say, you know what, I've actually got $50,000 in equity, in cash. I want to put it in the offset account. Now, how offset account works is, if you got $50,000 in an offset account, it's classified, or it's similar to a debit account, a savings account. Now, it's attached to the home loan. The money doesn't go into the home deposit, but what it does, it offsets the loan. So let's say, as you can see, let me just turn that off. You got a loan of $270, that you've borrowed from the bank. And if you've got $50,000 in your offset account, and I'm going to turn this on, it cancels it out and it makes out you only got a loan of $220 now because you've got $50,000 in the offset account. What happens is your repayments change. And as you can see, now you're actually positive $1,800. And so this is something that people don't take in consideration. They actually think you've got to use your cash all the time to buy property. Once you start using equity, this becomes one of the best tools to actually pay down debt faster and quicker. So hypothetically, let's say I've got clients that have equity and they do have a large amount of savings on hand. And what happens if you put if you put your $200,000 in savings? Now, some people might be thinking, "Oh, I don't have $200,000 in savings." Some of my clients do, and they got equity. So if they release that equity and buy the house with the equity, and then put that in savings, what happens is, if we look at your repayments, you're making now $9,000 from this property every year after all expenses have been paid. So you look at it, your income starts to increase. Now, let me just turn that off. And this is, as I turn it off now, your loan goes back, you got the full amount of 270, and you're negative $600 per year. But let's just leave it at that. And let's just show you that what happens is, over time, you're paying your principal and interest expenses. Now, your principal repayments, you're going to be deducting a certain amount of your home loan every year. As you can see here, that's $5,000 in that first year, and then of course every year it starts increasing the amount of money you're putting towards reducing your home loan. Now, why that happens is because the lower your home loan, the less interest you pay. So then you actually have more money that you put towards the principal repayments. So if you didn't have any money in your offset account in year 10, this property here will be at an average growth rate. What the Australian growth rate is 7%. Average growth rate. The property will be worth $590,000. So it's pretty much doubled in 10 years' time. Now, your LVR, you got 36% left on your debt to pay off. If we look at what your income is now, this property is positive cash flow. 4,600. So that's the money you'll be making after all expenses. And now, it's not a lot of money, you might be thinking, but it's still putting money in your pocket. But like I said, if you had money in the offset account at this point in time, and you reduce those repayments dramatically, your actual income would increase a lot more. So that's something to take into consideration. And people just look at, by that time it's only going to be putting, $4,000 in my pocket, or 4,600, and it's not a lot of money. But in that time, if you had your money in an offset account and you've actually smashed down this debt, and this debt's gone close down to zero, you look at it, you're actually going to have a higher income from the property. That's saying that we've only got I've factored in a 10% increase on a 3% increase on your rents. So what I mean by that is, every year your rents are going to go up $10. So we've factored that in over time. But what I want to explain as well, if you've got a property and you've done some nice cosmetic renovations, so you've updated the kitchen, bathroom, things like that, actually put the rent up quite significantly. You might put up an extra $40 to $50, $60 more per week, depending on how significant you've done the renovations and how nice the property is looking, of course, because it attracts the tenant. So that's something to take into consideration. Now, as we scroll here, I just want to explain, this is the property you purchased, and you put a 10% deposit, and you got a 90% loan, as we talked about. I've got your deposit that you're paying for the property. You got your pest and building inspection to make sure the property is nice and safe and sound. You got your insurance fees. You got your stamp duty. You got your solicitor fees. You got your mortgage fees, and then you got your LMI fees. All up in total, you're looking at the properties costing you $47,000 to put down a deposit. Okay, so if you put a higher deposit, of course, what happens is this value of the money you need for the deposit is going to be a lot higher. But as you can see, the property is not really affecting your lifestyle, so you would actually put less money in to the property, because what you'll do with your extra money that you have, you would probably put it in the offset account. If not, you would actually put it on towards other properties, so then you have more assets growing in value. So this is an explainer to talk about the offset account and how powerful that is, understanding about different values, or putting your money in at different values. So if it's a 10% or 20%, there's no right or wrong, depending on the client's risk management, of course. And as you can see, this is all on principal and interest. So I haven't factored anything in on interest only. If it was interest only, your repayments actually go up even more, because you're not paying the principal, you're just paying interest. So there you have it. That's something that gives you a bit of clarity. It's a picture of what you do. So if you didn't get this video, or you didn't understand what I was talking about, probably watch it maybe 2 or 3 times, and you'll get that understanding of where I'm coming from with this. So the offset account, offsets the loan. So if you've got a loan of 275, as you can see, if you've got say $50,000 in cash, you put it in your offset account. It's like a debit card, and it offsets the loan. What it does is, if you've got that $50,000 now in your offset account, it turns the loan into, even though you got the loan of 270 still, and makes out that you've actually only got $220,000. So it offsets the loan. So now the loan actually is like you've got a $220,000 loan, even though you still have to pay that extra $50,000 in debt, but just is offsetting. And then what happens is your repayments actually go up. And so if we look at it over time, as you go over time, here we go. The property, you're paying down the debt, and as you get to a certain time, if you kept that $50,000 10 years down the track, as you can see, your income that you're making is actually $6,900, so $7,000 after all expenses in year 10. It's putting in your pocket. Okay, and if you had more money in that offset account, you know the higher that's going to produce. So let's say hypothetically, you get the understanding. Let's say you've gone from $50,000 in offset account, now you got 100,000. As you can see, now that's $10,000 it's putting in your pocket. So it's a lot of cash that's putting in your pocket, and that's why you keep your money offset account. At least you got cash with you. You use as a buffer. You want to pay for expenses and things like that. That's what you always keep it in the offset account, so you got access to it. So like I said, if you didn't understand this, or you didn't digest this video quite well, watch it again. Maybe watch it 2-3 times. You get a better understanding, so it helps with your knowledge of understanding offset accounts, putting your deposits in, and using the offset account to advantage to build wealth.